house and then say too much, and then everyone cat's out of the bag. Now we know what they're planning. A few of the Fed members, specifically the one in Cleveland, had basically said, yeah, inflation's out of control. We're going to do everything we can to stop it, which is how this happened. Because they are so worried of every mortgage company, every bank is trying to stay ahead of these rate increases. We're kind of thinking we've already priced in the next 2 increases they're going to do at the federal level. Every company, every bank is already saying, well, if we know they're coming, we're going to hedge now, we're going to raise now so that we don't lose money on the back end. So that's why you see every single person with their rates up right now. I don't know that it'll go up much more. What would really kind of ruin it for us is if the Fed came out and said, well, we've increased it 3 times so far, and that's just not enough, so we're going to make it even harsher. Signs don't really point to that, although inflation still is not coming down. So to answer your question, yes, they are going to increase it. I don't know that it's going to be a shock to the market, so we might not see a spike in interest rates. I think it's a really good sign that we peaked and came back down a little bit. Kind of shows, you know, at least everyone out there in the market felt like they hit a point where, okay, we're probably overpriced, we can come back down now. Hey Rick.
Sorry.
Oh, you didn't miss much. The 15-year rate still pretty good. This is, you know, one that I think will come back down even further once the market kind of settles down a little bit. One thing that Sean and I both noticed the other day, normally the only 2 things we're quoting are the 15 and the 30. The 20-year, however, has come in to be, you know, really aggressive. There we go. There's a whole stack of info there. And I can post these in the chat afterward too. But yeah, the 20-year is really aggressive. So, you know, I've been kind of pitching the 20-year to people just to see how they feel. Yeah, your monthly payment's going to be a little bit higher, but the interest rates have tended to be a quarter less than 30. So, and the 15-year is not even that much better. So it's a nice kind of in between that people seem to be able to stomach. So this site, Mortgage News Daily, if you're ever curious, it's just a big, you know, survey of major mortgage companies on what their rates are daily, and they kind of do an average and report that. So something we go to see kind of how we are compared to general competition. So, all right, let me pull up something else really quickly. You're good. Half my class just walked out. All right. Give me 1 second here. I'm going to find these class materials. I'm going to post it in the chat for Adam here. There we go. Actually, I'm just going to screen share this. That'll probably be easier. All right. So the class was called non-conventional loan products. Technically speaking, conventional would be anything Fannie Mae, Freddie Mac, you know, truly conventional lending. These programs here would technically be outside of conventional, although I think that they have a day of classes all their own. I do want to touch on them for a second though, just because they are important. It's good to know that you have these options. Jumbo loans, so there are limits on the loan amount for regular conventional lending. That's $647,200, I believe. So if you have a loan amount higher than $647,000, you are now in jumbo loan territory. Jumbo tend to have a little bit higher interest rates, although not that much more. And you know, the qualifications tend to be pretty close to conventional. The biggest thing is going to be you know, you're not falling under the regular guidelines of conventional. It's more of a CCM specific product, or if you're shopping with any other bank or mortgage company, it's going to be their guidelines. Whereas with conventional, everyone's working under the same guidelines. The federal government issues those. So although it is a standard product and pretty much everybody's going to offer it, it does slightly vary a little bit. FHA, everyone knows FHA. I won't harp on that too much. I have a whole class on it, which I can do in the future. FHA 203K, those are, it says fixer upper here. It's a renovation loan. There's two big facets of it. There's the I don't even know how to describe it. Minor renovations, minor updates, something like that. Anything that's not structurally changing the property. You're not moving walls, you're not doing a big electrical changes, or, you can't put in poles, but I believe you can remove poles. So, yeah, so if it's going to be paint, drywall, cabinets, things that are aesthetic, that's going to fall under the, kind of limited category. And then there's the full-blown, this place stinks and I want to gut the whole thing and start over. There are separate rules for those. I can get into those details if you have someone looking at renovation loans, but FHA 203K is the renovation for FHA. There is also regular conventional renovation. Both of those programs actually go through a renovation department that exclusively runs these in cross country. Cross country, basically, they have this division of renovation. Let's say you have a buyer, they're going to go into contract on a property, knowing full well they're going to need to do some renovations. We would get them pre-qualified, get them into contract, basically get the entire file set up, and then hand them off to this renovation department. At which time the renovation department is going to help them find a contractor. We have a huge list of approved contractors. If you have someone that's not on the list, they can apply. It's super easy to get them put on the list. We would have them work with a contractor, come up with a budget, and basically sign on the dotted line with this contractor to have all these renovations done. Prior to the renovations being done, though, they close on the property. We do an appraisal up front, re-inspection on the end once it's all done. FHA renovations allow you to loan up to 110% of the appraised value, which is pretty awesome. Conventional falls under the normal requirements of 97% minimum, or maximum, I should say, 3% down minimum. So that's a cool product, and we don't do a ton of them because, one, contractors are hard to come by. Two, if you find that product, or I'm sorry, that property, and this product makes sense for you, the overwhelming part of the process tends to turn people off, where you're coming up with all of these changes you want done to the property. I mean, you have to basically work with a contractor to pick out everything you could ever imagine, to cabinets and countertops and hardware and everything. And once you've got it all figured out, sometimes the price is a lot more than what you might see on HGTV. So people get sticker shock really bad, and they've already gone through maybe 2 or 3 weeks of this process, and they're overwhelmed, and they tend to back off and say, well, I think we'll just try and find something else in the market. So don't do a ton of these, but in a shifting kind of market we're seeing right now, I wouldn't be surprised if we see more people just saying, hey, I don't want to mess with it. Let's try and do this reno loan.
Can you do a renovation loan if you're not doing it like if you've already closed on a property? Can you just get a renovation loan, or does it have to be paired with while you're under contract?
It would be paired with, yeah. If that happened, I would say let's look at doing a refinance, and you can, let's say you paid cash for a $50,000 property. It's worth 125, 150, but it's a mess.
Yeah.
Well, if we can do, get it appraised at a higher value, you can pull all that cash back out and then just put it back into the property. It's that's probably the direction I would go.
You had taught a class about CCM's doing like a cash purchase program.
Yes.
Can you do that paired with the reno?
I don't know. That's a really good question. That's kind of a molding of two departments. I would have to see.
I just got off the phone with somebody who likes a house but needs to change from conventional
To cash.
conventional reno.
Mm-hmm.
I was talking to the listing agent. He's like, "Oh, we really want a cash offer," which you can't do,
Right.
unless you can do something like.
Yeah. I mean, off the top of my head, I don't see why not. I don't know what the internal policy is with kind of molding those two departments together. Because so the cash plus program is not rolled out in Ohio yet, so I wouldn't be able to do it anyway. That being said, the way that it works is it's a third-party company that's putting in the funds in exchange for a small fee down the road to purchase the property for the buyers now, with the understanding that within 3 months, they will close on the property, basically transferring from the third party over to the buyer. The closing costs and the fees pay back the company for coming in and boosting into a cash offer in the short term. I think if that company is okay with doing a renovation loan, that'd probably be no problem, but don't hold me to it. I don't know for sure. That's probably gonna, that would go pretty high up this CCM ladder, I imagine, before we knew. Good idea though. USDA, don't do a ton of these, but they, we are not far in Cuyahoga County from plenty of places where this program would work. I know Sean maybe does, a handful of them a year, but basically, it's a no money down rural loan. Are you guys familiar with that? If you're in an area that qualifies for USDA, and generally it's going to be a rural area that, the median income, I can't remember what the requirements are. Most counties in Northeast Ohio, it's going to be like 60,000, something like that. So if you fall under that, you're going to be able to qualify for this specific government-backed loan program. And there are some other requirements there. Like I said, I haven't done one before. Sean does a few of them. If you have any questions about it, or someone's like, "Hey, I heard about this," send them my way. I would love to, learn more and walk them through that. VA, I'm sure everyone's familiar with VA. No money down, no PMI. And if the veteran qualifies for a disability benefit, most likely their funding fee is waived. So great program. I have a whole class on that as well. Probably that is definitely on the training calendar for next month. So this kind of gets me into the bulk of what I wanted to talk about today, which is CCM signature products. These are products that are exclusive across country in the specific underwriting. Most of them we're doing the underwriting in-house ourselves. If not, we're doing it once and then having another broker take a look at it again and kind of sign off on our underwriting. These are programs that are going to help your non-traditional buyers get financing. One big catch with these is because it's non-conventional, you'll see non-QM, non-qualified, meaning it doesn't fall under the normal guidelines. There tend to be a little more inherent risk to these. So you're going to see, maybe a little bit higher closing costs, maybe a little bit higher interest rate. Specific to the doctor loan, I don't even look at fixed rate mortgages or fixed rates because they're so high. Immediately, we're going to look at ARMs, adjustable rate mortgages. So to start the doctor loan, I know I mentioned one on the shareholders meeting the other day. Awesome program. Does take a little bit longer because it's one of those ones we have to have it double underwritten. It takes about, I would say, 35 to 45 days is comfortable. No money down, no PMI, The loan amounts are insane. It's no money down up to 750. You can take it all the way up to $2 million, and I think you only have to put 10% down. We never run into anything that high. Most of the time, the people that I work with the most for this program are new residents. They've got a ton of student debt. They make $62,000 or something like that for the next couple of years until they get their fellowship or their, their full-time job or their big job. They want to buy a house now, but they know for sure they're moving down the road. We'll do a 7-6 arm. That's 7 years fixed. And then every 6 months after that, it adjusts based on a market index. Most people, if they're a resident, they're not going to be living in this house for 7 years. They're going to, let's say they fall in love with it or something. Cool, call me back, we'll refinance. But most of the time, they're going to be moving on to the next big property anyway when they're making, 150, 200,000 rather than 60. The program itself, like I said, it's pretty fair, I would say. Doctors, dentists, pretty much anyone in the medical field. There's even a branch of this program that is for medical professionals that aren't physicians, which is cool. Rates are a little bit higher. I think they have to put a small amount down, but not a lot. The other big thing about it is the student loan calculation. Let's say, you're a doctor, you just got out of med school, you have $150,000 in loans, but you're only making $60,000 a year. Their student loan calculator bases it off median local income and your income. And then it has a factor. I plug it into the calculator. I do not know how it comes up with these numbers, but it also looks at how many people there are in your family. So, a doctor with 3 kids is going to have a different student loan calculation than a doctor who's single. Once it kind of takes those numbers and, chugs out whatever calculation it has, I've seen it where someone with $150,000 in loans, we only have to plug in $400 a month for the payment. Whereas if you were conventional, it would be, $1,500 a month. So pretty sweet program. That one I do fairly often. Yeah, for sure.
So my brother's girlfriend is a second-year resident of the city.
Okay.
And after the last class, when we touched on this,
Mm-hmm.
I said, hey, Kim, I was at this class and they were talking about the doctor and how, she's running right now. I said, how you can get, buy a house with zero down because you are a resident.
Mm-hmm.
And she said, yeah, she's like, I heard about that. I've got friends that have gone through this process and then they end up saying that they end up doing a different, like either conventional or FHA or something because of the zero down, their actual like monthly payment is so much higher.
That is somewhat true because you're putting no money down. Your loan amount, it's $250,000 purchase price, $250,000 loan. Now you don't have PMI, so that's nice. If you do the adjustable rates instead of going with a fixed rate, it's more aggressive than what you would normally see. So the only place that really narrows them into is, let's say we do a 7-year arm. Ultimately you're going to want to refinance it before that, or you're going to wind up moving anyway. We have longer arm terms. You can do 10 years. There's even a 15-year. Now, it's not that much more advantageous than the fixed rate anyway, so I usually steer people away from that.
Yeah.
So you're absolutely right.
I didn't really know how to come back to that. Okay. Let
Yeah.
me talk to you in a few weeks.
The alternative I would say is, okay, so if we have the doctor loan, we know that's a possibility. Let's look at conventional by comparison. Student loans, definitely going to hurt. Now, if you don't have student loans, conventional is going to look really good. The other part is PMI. So if you have I would say this: if you have 20% down and you don't have a huge student loan burden that is killing your debt to income ratio, I'm probably going to push you toward conventional too. That's probably going to make more sense because we can lock in an interest rate that's aggressive for 30 years rather than doing an ARM where we get 7 years and then come back to it. It's a benefit to people with the student loans. Maybe they don't have a ton of money saved up for a down payment. If they're okay with the ARM situation, I think it makes a lot of sense. If she has questions, call me, because I would love to run that scenario and say, okay, in an email, here's doctor loan situation, monthly payment. Here's conventional monthly payment with a breakdown and everything. I would guess if you're putting 5% down conventional versus no money down on the doctor program, they're going to be pretty similar. Yeah. Bank statement and 1099 loans. This is kind of a rare one. We only run into it, when you have someone who's self-employed that really kind of has funky income. Yeah, there you go. Yeah, like realtors. So most of the time, I work with tons of self-employed borrowers. Please send them my way. I look at too many tax returns and I know too much about them not to use it. So please, I would love to help. For those that have really weird income, their profit and loss, they're like, what's a profit and loss? You're like, oh no. This program is going to work for them. We're going to base it off of bank statements showing business income rather than traditional income from 2 years of tax returns. You need a ton of bank statements. That's the one catch. All pages included 12 months. It's a stack of paper, but they're going to look at 1099 income, and if you're truly traditionally self-employed, the bank statement income, and derive from it a usable qualifying income. Aside from that, it's pretty much like any other conventional program. It's just the way we come up with income is definitely different than what you would see traditionally. You are going to see interest rates being slightly higher on that because it is a little
All right, you're good to share now.
Hey, Adam. We finished the class. Just kidding. But yeah, some Magic the Gathering card, guy sells it for like $2,000 or something, and that's how he comes up with what he needs to close. So those were both FHA. So you know, those don't even fall under the non-conventional, so to say. Asset qualifier. There's kind of two sides of this. There is specific programs that work just off of this. Basically, if you have a ton of money in your savings or in investments, we can derive a portion of income from it. Or we have a calculation to say, well, you know, this person has $6 million in their, you know, investment account. We're going to come up with a calculation if they were to pull out of it every month for the next, you know, 20 years, here's how much income they would have. And this will work even if they're, you know, unemployed.
So would that be for like a trust? Or what would it be?
Trust might be different. We might need trust terms showing that they are in fact receiving some kind of payout from the trust. This would be purely someone just has a ton of liquid or liquid funds saved up.
So they wouldn't have to show like job history or things like that because they just have so much money. Who cares?
Yeah.
What's the next?
Yeah, right. Rick's guy who had a business with weird business income, you know, I might look at this program too, where if you look, I'm self-employed, but I write everything off. I haven't paid a dime in taxes in 10 years, but I have a ton of money in the bank. Well, maybe we can make this program work. The other side of this is a conventional, you know, kind of tool, I would say. Fannie and Freddie have their own rules for it, but if you're over 59 and a half, meaning you've reached retirement age, you have money in, you know, some kind of savings account, 401k, retirement savings account, we can do a calculation to come up with usable income from that without you having to call your investor or your financial advisor and set up automatic draws. If you do have automatic draws, perfect, we can use that income, but we have a tool to do it without needing you to go to you know, set that kind of thing up. We had someone, might have been a couple months ago now, really wild situation. She had $1.2 million in a regular old savings account, collecting like barely any interest. But we were like, well, yeah, we can basically come up with a usable income from this, even though you're not actually pulling anything out of it. It's just cash that's sitting there. Financial advisor, you know, would be salivating at that, but investor cash flow loans. You know, this is a program that definitely is under CCM signature. However, I'm going to look to take my investors conventional every time. I work with a ton of investors. Usually we are able to get them through conventional. Now, cash flow, looking at, you know, bottom line after you have paid expenses and everything, how much money are you going to be making from this property? Generally, we're using leases unless someone has been, you know, paying, leasing the property out for more than a year, at which point they'll have a Schedule E through their taxes, and we'll see, you know, how much they're claiming on their taxes they're making from this property, and we'll use that. You can use subject properties rental income if you have a past, if you have past experience in being a landlord, and you have current leases on the property. I think that the catch with this program that kind of sets it away from conventional is you can do prospective rent, which is as a part of the appraisal, you pay an extra $150. The appraiser will not only give an opinion of value, they will give an opinion on rental income. They can say, well, in the market, this is what you're going to make on this property per month. So you can use that in this sense, even if it's not leased. Foreign national loans, This is one we definitely do not run into very often, but we do have it. I think the second page of the packet I gave you guys, and I'll post this in the chat, has a little bit more on guidelines for all of these products. The ITIN program is this foreign national program. Basically, someone who is, working here, maybe on a work visa, but is not a resident, doesn't have a social security number. They might have a social security number, but they're working on a visa. I'd have to look into that. That one, like I said, is pretty rare. I could see, other parts of the nation using that program a bunch. Here in Cleveland, I haven't run into it too much. And then full doc loans. That's kind of a catch-all, other brokered programs. So a lot of lenders work like this, including us. We work with other banks, basically. They might have one-off specific programs to them that have non-conventional guidelines. They might have higher interest rates, just like any of these other products, but they have guidelines that would fit very unique situations for borrowers. We have a ton of them. I can't even name them all off the top of my head, but I have a matrix. It's basically an Excel spreadsheet of, all the guidelines, who this benefits, what buyers need. I mean, a lot of the time you're going to need more money down, but let's say someone's in a really weird situation. We don't think that we're going to be able to get them qualified. I can always look to some of these brokered, other banks and say, well, here's how this will work. We'll put it together. We'll set it all up. We'll underwrite it, and then it's got to go to, XYZ bank, and they're going to do their own set of underwriting. Assuming it's approved, it comes back to us, and we'll push it through. Pretty rare to do these, but every now and again they will kind of come across my desk. But yeah, I also included in here some stuff on mortgage basics and a program cheat sheet. Those are more FHA, VA, USDA, conventional. The other programs I wanted to address, construction loans. We have a construction department here at Cross Country Mortgage. Fairly new. We're one of the few branches in the country that have it as an option. Basically, you would get someone pre-approved. Maybe they're buying a plot of land and the seller's willing to be, work with them a little bit, or maybe they already own the land. That's kind of the easier way to do it. What we can do is, basically, it's similar to the renovation program. They've worked with a builder, they've picked out the doorknobs and the light fixtures, and they're in contract. Now, they send that contract over to us. We've already gotten them pre-approved. We're going to send it over to our construction department. Construction department is going to look to lock them in an interest rate for the next year. They look for 9 months first, but it's so rare to run into a builder that can build in 9 months right now. So we'd be looking to lock most likely for a year. Interest rates are a little bit higher on those, like any of these products, but it's a great program, and our department will manage all of the funds going to the builder. So builders needs to be on an approved list, but it's super easy to get put on it if they're not already. Well, it's time to dig the foundation. They put in a request to Cross Country Mortgage Construction Division. Cross Country approves it, sends them a check, and then they dig the hole. Then they go to do the foundation. Same deal. Then they're going to go order the lumber. Cross Country sends a check. So they manage it through the whole process. It's a one-time close up front. Depending on FHA or conventional, both of the programs are available in the construction department. One, you have to pay interest during the construction process, and then your regular mortgage payment will kind of start at the end. The other one, you pay nothing during construction. The interest gets lumped into the loan amount, and then, once it's all done, you start paying once you're moved in. So either way, pretty sweet program. I wish that we were in a market right now where people could build and it was viable to build. I have, almost 7 years of experience in the building industry. I would love to work with people and seem like I knew what I was talking about whenever they have questions about construction and financing. That being said, everyone I have gotten pre-approved for construction loans ended up buying existing because they didn't want to wait. They didn't want to deal with it. So we have a bridge loan at Cross Country. Bridge loan is basically, you don't have the equity, or I'm sorry, you don't have the funds to put a sizable down payment on your next property, but you have the equity in your current property. You don't want to have to sell first. So how do you access that equity? We do a loan on it. We're going to give you a loan for a portion of the equity in the property. You're going to use that for your next down payment. There are closing costs on that first loan, and then you'll have closing costs on the second loan. The bridge loan gives you a year to purchase your next property. If they have funds already, I'm pushing them to the recast every time. Recast, basically, let's say you already have 20% down in your savings account. You don't need to sell your current property. You just don't want to have to worry about selling it first and messing around with that. What we would do is we would qualify you based off of carrying both mortgages at the same time. You go purchase this new property, put 20% down, and close. Now you sell your old property and you have a windfall of cash, and you're like, well, I just want to put all that money back onto the principal on this new house I just bought. As long as you're not paying it off entirely in the first 6 months, not a problem. There is no prepayment penalty, but the paperwork that gets moved around and the loan gets sold, down the road, it'll never reach its final destination in the first 6 months. And if you paid it off, it comes all the way back to the branch, and then we have to pay back all of those fees. So we are very, kindly asked not to do that. So that recast only costs $350, whereas the bridge loan might be a couple $1,000. So generally what I do is, someone calls me, they say, I want a bridge loan. And I say, you probably want to recast, send me your bank statements and let's see what you're qualified for, and we'll see which works best. Down payment assistance, that generally is falling under these categories up here: standard products, either FHA or conventional, but I run into it a ton. There's OFA and Communities First. Those are the two that we work with. OFA, super common program. Everyone has it in the state of Ohio. I'm sure you have heard about it and maybe done one in the past. Basically, it's a second mortgage on the property that's going to be there for 7 years. Once you've reached the 7-year mark, the state of Ohio is going to forgive that second lien on the property. You were not able to refinance or sell the property within the first 7 years, or you have to pay that second lien off. Generally, they're going to give you 2.5% to 5%. One of the areas I love to use it most is, if you're going conventional, you have a low enough income but high enough credit, you can qualify for Home Ready, which is, I think we talked about that a couple weeks ago. It's like it's a first-time home buyer program, but as little as 3% down. Well, if you're getting a 5% OFA grant, so to say, second lien, but we're only putting 3% down for the property, what do we do with the other 2%? We get rid of almost all or all of your closing costs. So you can basically go no money down and just work through this one program. So pretty cool. Those ones, it's kind of tough. The website for OFA is pretty vague. Communities First, a little more information, but still not a ton. A lot of borrowers feel like they probably qualify for the program, but digging in a little bit more, they might make too much money, or maybe their credit score is just a little too low. You're generally going to have to be over 650, and you're going to have to make less than 62.5 here in Cuyahoga County.
Is that as like a couple or
Household? Yeah. The places that I've seen it work, most often are single people, right? Because Or, we can always, assuming that it works, obviously, we can, take one borrower off, put them on title so they still own the property, but they're not on the mortgage, and then just qualify them that way. Communities First is a really good program. Communities First true grant program. I believe it's a 2.5% or a 3.5% grant. And that's not like a lien, you don't have to pay it back ever. If you qualify for the program and it gets through underwriting and closed, there you go. That money was gifted to you. Don't worry about paying it back. Now, with the interest rates and the market being crazy right now, Communities First has put their program on hold. We did see one FHA come through the other day. They regularly send us, hey, here's what's the rates are like for this program. And for about the last 2 months, it was just NA on all of it. But last week there was one program. I don't know if it's the one that we work with, but it did see an interest rate on there. So hopefully they start rolling that back out now that things are calming down. And then the other thing I wanted to mention was student loan refinance. Another rare one. Sounds like some student loans are going to be paid off here soon. I don't know. Watch the news, I guess. But assuming that not everyone's student loans in the whole country are forgiven, and those of us out there that have them are going to have to keep paying on them, you can refinance them into a new mortgage. Now, 6 months ago, even a year ago, would have been a sweet time to do that when rates were 2.75%. Now they're up to about 5.5%. I think my student loans are like 6.5%, so it's still a good idea now, which is insane. But if someone wants to, wrap that all into one loan and have it under their mortgage, they absolutely can. I believe it falls under just regular old conventional guidelines. They'd have to have quite a bit of equity in their property because we can only pull so much out. It's more or less like a cash out refinance where you're using that cash to pay off these student loans. There's definitely some benefits to it. And if you have someone that's looking to consolidate some of their debt, let me know. It might be something that can help. Cool. I think that's it. Do you guys have any questions? You have any questions, Adam? Yeah.
Doubtful, he's a sponge for information.
All right.
Is this something that could be directed towards our clients, like at an open house?
Yes. So with all of the flyers that I'm handing out, and this goes for this class today, every flyer I have, through Total Expert, I can plug your information in, the agent's information in there. It'll be my picture at the bottom there on the left, your picture right there next to me on the right. All I need is, your contact info and a headshot, and I can set it up manually. Or if you'd like, I can send you an invite to create a Total Expert account, and then you can, upload that stuff yourself. When it comes to printouts like this, I can do them right here in the KW Living office. I can print them out and hand them to you, no problem. If you want to do something on a bit heavier stock, maybe you want to do something like a postcard, or there's whole classes that you can, print out brochures and a whole bunch of stuff. Some of that we have to order out and we have to split costs to stay compliant. But when it's stuff like this, it's super easy. I can just print it out. So, yeah. Yes. Yeah, let me know. I have to, for the MSA, get flyers in open houses. So if you have someone that likes this stuff, let me know. The other thing I need for the MSA is if you have anyone who would be so kind as to post about cross country, myself being in the office, on their Facebook, social media, anything like that, let me know. I will put it all together and send it to them and have them okay it. But I need to I think we need 2 agents a month to post about us being in the office. So.
I'll do it.
Hey, thanks.
Mhm.
That'd be great.
My daughters, I picked them.
And then I have 2 tickets to the Indians game next Friday. Dollar Dog fireworks, section 125, low corner, like 7 or 8 rows off of right field. If you or someone you know wants those, I am going to the Dave Matthews concert,
Nice.
so I will be missing that.
I'll take it. Concert ticket.
Yeah. My wife's work, her law firm, we signed up for it months ago without planning. Obviously, that's how I have tickets to 2 things on the same night. They are taking a bus to this concert, and we're going to it, and then we're taking the bus back. So very exciting. Going to be a lot of fun.
Is it a blossom?
Yeah.
That would be great.
So I'm excited. That does leave me with Guardians tickets. So if anyone wants those tickets, or you know anyone, let me know. Next week, not tomorrow, next Friday. Cool.
Thank you so much.
Yeah, absolutely. Thanks, guys.
Thank you.
Better